Okay, now I'm going to talk about the chapter 2, section 4 about taxes. Okay, so in Canada, we are reporting the government, the Canada Revenue Agency. They are responsible for collecting taxes from the legal entities in Canada, including individual and corporate. So each year, I think the deadline is April 30th. We have to, each individual will have to, if you are a resident for the tax purpose in Canada, you have to file the T1 income tax return to report your earnings. And the corporation, they will have to report a corporate tax. So that is due 6 months after the fiscal year end. So corporate tax is not go with the calendar. So the individual tax is go with that calendar. So every year the deadline is April 30th. But corporate taxes is go with the fiscal year end. Could be anytime during the year, and the deadline is 6 months after that. Okay, so and in tax rate. So tax rate, there are two different concepts. One is called marginal. The other one is called average. Okay. So what is the marginal? Marginal is the percentage paid on the next dollar earned. So what happened is in Canada, we have different, instead of charging a flat tax rate for all the income you earn, the tax rate is progressively increasing as your income level going up. Okay, so they divided it into different tax brackets. Within each tax brackets, there is a fixed tax rate. Okay, when you earn more money, the income rate is going up. It's higher and higher. Okay, so the marginal tax rate is that the percentage of tax rate paid for the next dollar you earn. Okay, and what is the average? Average is that the percentage of your income that goes to pay tax. So you calculate what's the total amount of tax you need to pay divided by income. That would be the average tax rate. Okay, marginal and average is different. So marginal tax rate will be higher than the average because the earlier dollars you earned is taxed at a lower tax rate. So the marginal, as it go up, the higher dollar you are earning is taxed at a higher tax rate. So the marginal tax rate would be always higher than the average. So I'm going to give you one example to make sure I understand this. Okay. So for 2022, the federal tax, the tax bracket, there are 1, 2, 3, 4, 5 tax brackets. And the tax rate is 15, 20.5, all the way up to 33%. So it's increasing. And the amount of federal tax calculated is for each bracket is this. Okay. So now you can see that the first $50,000 you are taxed at 15%. And the next $50,000 you are taxed at 20.5%. So also suppose my income is 155,625. So in the middle category. Okay. So if my income is $155,625, the next dollar would be 155,626. So that will bring me to the next level, right? The next level, the rate is 29%. So the marginal rate is 29% because that's the tax rate. My next dollar is gonna be taxed, right? Because I'm here right now. The next dollar will be 626. And the 626, that $1 will be taxed at 29%. So that's my marginal rate. What is the average rate? Okay, so I'm making 155,625. So the total tax paid would be these three together. So I add up this tax owed for each of the three brackets. I add them up. That's the total tax I owed to the federal. And then divided by the income. So it turned out to be 20.68%. Okay? You can see marginal is 29%. The average is 26.8%. So the marginal is higher than the average. What about taxes on investment, right? Because this is a finance course. We are dealing with investment. What are the taxes on investment? So investors, they may hold the stocks, right? So they are subject to basically two types of taxes. The first one would be they receive dividend, okay? They receive dividend. So if you learn income tax, what happened is depending on the type of dividend. So it could be an eligible dividend or a non-eligible dividend, okay? What are these eligible versus non-eligible? I don't want to talk about it here. But the point here is that if you receive $1,000 dividend, you have to gross up. You have to multiply by a number. Either it's 138% for eligible or 115% for non-eligible. So you gross it up, okay? So that number will be as your income. You have to report in your T1 return. Because you grossed up, you report it higher, the government wants to give that money back to you. They give it back to you in the form of a dividend tax credit, okay? So what is this dividend tax credit? So basically, they can use this credit against their liability, okay, on the grossed up portion of dividend received from the Canadian corporation, okay? So you have a grossed up dividend income that you have to pay tax on that, but they give you this credit so that that credit will reduce the amount of tax you are going to pay, okay? Why it's like this? It's about integration concept that you can learn from the income tax courses, but here I'm not gonna talk more about it, okay? Capital gain tax. Capital gain tax is, so when you buy something, buy these stocks at $50, you sell it for $60, right? So there's the capital gain of $10. So how this works is 50% of that gain will be taxable. So $10 times 50%. So the taxable amount would be $5, okay? So that's the capital gain tax. Capital cost allowance. So now let's talk about a different concept called the CCA, capital cost allowance. So what is this? It's called CCA, okay? So if you have taken accounting courses before, you learn that for the long-term asset, every year you have to depreciate over the time, over the number of the years of useful life, right? This is due to the matching principles, right? Because you use the asset, that asset help you generate revenue. And what is the expenses, right? The expenses is the use of those equipment, property, plant, right? And the use of that expenses is called a depreciation, right? Depreciation. So for every company, they would think a depreciation method for their accounting income purpose, right? So every company have their own book. They're going to report an income. That income is called accounting income. And you can use your own depreciation method. But when you are dealing with Canada Revenue Agency, CRA does not want people to have their own standard. Instead, the CRA have his standard. Okay, CRA will define each asset at what class, depreciate at what rate. So this is not an accounting choice for the corporation. CRA, because CRA wants to know their income for the tax purpose, okay? So CRA has to have a consistent standard in terms of this depreciation, right? Quote, in tax terms, this is called capital cost allowance. Okay, so it's equivalent to depreciation in accounting. So it's a terminology in tax. Okay, so CCA will reduce the taxable income. Okay, so they act as a tax shield. So the CRA will already designed each different type of capital asset to a different asset class. And each asset class is given a depreciation method and a rate. So for example, if you have a building that is acquired after 1987, so according to CRA, this property will be put into a class 1. And this is double declining amortization depreciation method, and the rate, the annual rate is 4%. Okay, so I don't care which company it is, as long as the building acquired after 1987, then it belongs to class 1. The rate is 4%. Furniture, appliances, and tools costing $500 or more. So if you have a desk, right? If you run Airbnb, you got a new oven, right? Appliances, right? This is all belong to class 8, and the depreciation rate is 20%. Computer hardwares and motor vehicles, so class 10, 30%. Patents, franchised, concessions, license for limited period of time. This is considered as intangible asset. Okay, this is considered as intangible asset from the accounting purpose, and the amortization method is a straight line. Okay, and this is the class 14. So you just have to know the number of the years of useful life. Let's say it's 5 years. Based on a straight line amortization, that'll be 20% each year. Okay. Taxi cabs and rental cars, class 16, the rate is 40%. Machineries and equipment, class 43, and the depreciation rate is 30%. Okay, this rate are prescribed by the CRA, right? CRA has decided these are the rate you are going to go with to do the calculation. So this rate are the prescribed rate, okay, for the class. Interestingly, there is a rule called accelerated investment rule, okay? So these rules are for the properties acquired after November 20th, 2018, and this become available for use before 2024. If this property is acquired after November 20th, 2018, and is available for use before 2024, so this rule will apply. This rule applies on the first year, the prescribed rate, this prescribed rate will be timed by 1.5. Okay, when you do the CCA calculation, on the first year, you're going to use 1.5 times the prescribed rate to do the CCA calculation. The reason why it's called accelerated investment rule. Why it's accelerated? Because the first year CCA is 50% times of higher. They make the CCA 50% higher. Okay, that's why it's accelerated investment rule here. Okay, so that's important. When you do calculations, you want to keep that in mind. So these are the class, and these are the different prescribed rate. And on the first year, if the property meet this condition, the prescribed rate will be timed by 1.5 times. Okay. So let's see one example. ABC Corporation purchased $100,000 worth of photocopies in 2020. Photocopiers fall under asset class 8 with a CCA rate of 20%. How much CCA will be claimed in 2020 and 2021? So first, don't forget that calculation, the rule, right? The rule is about for properties acquired after November 20th, 2018 and available for use before 2024. So here, these are purchased in 2020, and it's used right away, right? You buy a photocopier, use it right away. So the rule, accelerated investment rule, applies here. So now when I'm calculating my CTA, I have to make sure I use 1.5 times the prescribed rate, which is 20%. Okay, so this is my calculation. So I use the cost, $100,000 times the prescribed rate, 20%. But here, this is the first year, and this is the rule applies here. So I have times 1.5. So this gives me 30,000. So what's the ending balance? So 100,000 minus CCA. So this one will reduce the value of the asset. Every time you take the depreciation from the accounting perspective, your carrying amount of the value asset go down. The same idea. The beginning fixed asset tax value is 100,000. After you wear it out by 30,000, so there's only 70,000 left, the tax value. So the ending of 2020 is the beginning of 2021, 70,000. So next year, we are not going to use that acceleration rate rule because the rule is only for the first year. This is the second year. So we use the opening cost, opening tax value, 70,000 times 20%, which is 14,000. And the difference is 50,000 ending balance. Okay, so this is how you do the calculation of the CCA. I hope this makes sense. There are some additional concepts I want to talk about here. Usually, okay, you may have more than one asset in one class. Let's say you purchased 8 photocopiers, right? They all put into the class 8, that class, right? So there are multiple photocopiers, right? Okay. One asset is sold. If you sell, let's say 1 of them, this asset class balance, the balance of the tax value of this asset class is reduced by a number. What is that number? The number is the lower value of the realized value of the asset and its original cost. So if you have asset originally cost $100, now you sell it for 50. So the lower of the two would be 50. So what happened is when you sell it, the tax value of that asset class will be reduced by $50. Okay. Closing an asset class. So when the asset is the last one in the asset class, when that asset is sold, there's nothing left for this asset class. You have to close this asset class. So this time, you're gonna likely to trigger either a terminal loss or a recapture CCA. Okay, so what is the terminal loss? Terminal loss is that your tax value before the disposal, okay, is different from the disposal amount, right? So the low you dispose it for a value, so whichever less, right? So if you have the machine, you purchase, the cost is $100, you dispose it at $50, okay? So now the lower of the two, right? That's the 50, okay? So you're gonna compare the 50 with the ending tax value of the asset before it's sold. Okay, if 50 is lower than the ending value, so that will be a terminal loss. Okay, if the proceed is higher is higher than the if the proceed is higher than the cost, what happened is you are going to have a recapture of CCA. Okay, so I'm going to say this again. If the disposition proceed of the last eyesight is lower than the terminal. It's lower. Sorry, if the disposition proceed is lower than the cost, okay, how much you paid for it. What happened is you compare the cost, you compare the proceed with the ending tax value before the disposal. Okay, so you may have a recapture or you may have a terminal loss. If your proceed is higher than the cost, you are going to have a capital gain, right? The amount of the proceed exceed the cost. That's a capital gain. At the same time, the ending tax value versus the cost, the difference would be a recapture of CCA. So this just to talk about this conceptually is very challenging. So I'm going to go through this with you using one example. Okay, so in this example, Cool Drinks Corporation purchased $300,000 worth of bottling machinery in 2019. Machinery falls under asset class 43 with a CCA rate of 30%. In 2021, Cool Drinks sold their machineries for $150,000 and moved their production to Mexico. Was there a capital gain, a CCA recapture, or a terminal loss? What if the machineries was sold for $75,000? Okay, so let's take a look at here. Okay, I'm going to use this pen here. So the machinery, okay, is purchased in 2019. So now the rule will apply, right? Because the rule applies to anything after November 20th, 2018. So if you acquire a property after November 20th, 2018, and that property is available for use before 2024, the rule will apply, right, to the first year. So the first year is 2019 here. So the opening tax value, that's the $300,000 UCC. I'm going to calculate CCA. So how did I get this number? So first, I use opening $300,000, and then you times the prescribed rate, which is 30%. Okay, but don't forget the rule applies to the first year. You have to bump this up times by 1.5. Okay, so this will give you 135,000. And now you take the difference, 300,000 minus 135,000. So you get 165,000. So this is 300K minus 135K. So opening minus this allowance, okay, and that's your ending. And so the same number ending will be the beginning of the next year. How did I get this 49,500? So this is the second year. The rule won't apply to the second year. So I just use opening 165,000 times 30%. So that's how I got this number. And then the difference, 165,000 minus 49,500. So the difference is this number, 115,500. And that's the opening of the next year. And again, this opening 115,500 times 30%. So I get 34,650. and the difference between these two is 80,850. Okay? So we are saying at the end of 2021, the tax value would be 80,850. So in the information here said in 2021, they sold the machinery for 150,000. So this 150,000 is the proceeds, right, of sales. So you sell this, you sold this equipment for $150,000. So that's the proceed of the sales. And what's the cost? The cost is of the machinery. When they first buy this machinery, the cost is 300,000. Okay. If the proceed is lower than the cost, there's no capital gain. Capital gain means you sell something more than what it cost you, right? It costs you $300,000, you sell it for $400,000, you have $100,000 capital gain. But now you sell it under the cost, so there's no capital gain. Okay, so because this proceed is less than $300,000 cost, so you have no capital gain. Okay, so what about the others, right? Okay. So 150,000, that's how much you get in cash, right? But for CRA, from CRA's perspective, the value of the asset is only 80,850. So you sell it more than that, right? You sell it more than that. That means you have taken the CCA too much before. Okay? You take too much CCA, so you have a lower tax value, right? See, the market shows that your tax value is really $150,000. It's not 80,850. And the reason why it's 80,850 is because you overtaking CCA in the previous years. So now we have to add it back. We have to add this CCA recapture. So the CCA recapture would be 150,000 minus 80,850. So that's the 69,150. So that's the CCA recapture, okay? And here's another question. What if the machinery was sold for 75,000? So let's say it's not 150,000. Let's say it's $50,000. Excuse me, I'm so sorry. So now you compare the cash you received is $50,000, but from the CRA's perspective, the tax value of the asset is 80,850. So it's a lose, right? Because you are hoping you can sell it for 80,850, but you only sell it for 75,000. So when you compare that, you have a loss, right? The loss would be 58,500. So you use 75,000 minus 88,50. So this is a negative number. It's a loss, term loss. Okay, 580,550. Okay, so that's this question. Okay, so that's it for the tax.